car loans used to be 3, maybe 4 or 5 years long at the most. Now, many are 7, 8, or even 9 years long. New data shows that more and more Americans are choosing to stretch out their loans to keep their monthly payments down. Phil LeBeau joining us now with more exclusive data. Phil, it's just shocking. 9-year car loans? I mean, you're going to owe more when the car is worth nothing.
Well, it doesn't make sense to most people, but that's what we're seeing, people stretching them out. We have the latest numbers from Experian, and this is an exclusive first look at what people are doing when it comes to auto loans. First of all, the average credit score has dropped down now to its lowest point since 2008. The new car average loan amount financed is well over $25,000. And how are people affording those more expensive loans? Well, they're stretching out their payments. Look at the change in terms of the terms here. The big shot up here is in the 6- and 7-year loans. They're up 26% year over year. In fact, 58% of all new auto loans are at least 5 years in length, the average 5.3 years. And in the second quarter, the average new car monthly payment, $452. That's up $2 from a year ago. Take a look quickly at the auto dealer stocks. Now, most of these stocks this year have had a pretty decent run. You see a few of them that have fallen off. But generally speaking, Brian and Manny, what we're looking at are people going in and saying, I want to pay more and I want to stretch it out further.
What's the risk here?
What's the risk?
Anything? How's the default rate? Do we know anything about that?
Yeah, we do. In fact, we reported on this a couple of weeks ago. The default rate is still low and the repo rate is still low. But you have to wonder, is that because we're looking at defaults and repos from 08 and 09 when a lot of people couldn't get car loans? So therefore, you had primarily prime borrowers who are taking out loans. Now you're starting to get into that subprime market a lot more as the economy expands.
Phil, stick around. Let's bring in Scott Adams. He is president of Adams Automotive Group in Kansas City. Let's get his perspective on this trend. Scott, is this a good thing or a bad thing?
Well, good afternoon. Probably some of both. A lot of people anymore are getting 0% financing for 72 months and very low financing for some of these 84-month loans. So it's almost impossible for them to be upside down. The average car on the road today is 10 years old and has 150,000 miles. So what we're seeing is a lot of pent-up demand, and there's people trading in cars now that they have equity in. So it isn't quite as bad as it looks, and the people that are selling these cars, they seem to stay in equity the whole way, and they're paying their bills. As you guys noted, auto delinquencies are down to the lowest they've been in the last 10 years.
Scott, but I got to take issue with one thing you said there. You mentioned the 0%. The fact of the matter is the average used car auto loan right now, the rate is 8.5%, or I think it's 8.9% according to Experian, and the average new car interest rate is well over 5%. So this 0% is out there. The reality is a lot of people are not getting 0% loans.
I think that's somewhat true again as well, but the mass market, the mid-market cars, the Toyota Camry, Ford Focus, the Nissan, the Hondas, those cars do have 0% financing available. And most of the certified cars that are nearly new, a lot of them are 0.9 financing or 1.9. So I do see both sides of this, since in another career I also do banking. But still, the people are paying their bills and they're not past due, and there's a whole bunch of pent-up demand.
Scott, can I ask, who is the average customer for this kind of longer or extended auto loan?
It's not who you would expect. If you just picture middle America, the people that will be voting in Ohio or Iowa or here in Missouri and Kansas, it's more that type of person, a person that's got a budget. Maybe they don't make a ton of money, but they've lived in their house a long time, and their car is worn out, and they need another car.
Yeah, and speaking of that, what's selling? Let's change gears a bit right now, Scott. I want to know what's hot.
What's hot's the middle market. Ford Fusion, Toyota Camry, Honda Civic, a few of the hybrids like a Prius and that. Really, the small cars are the surprise right now. The real small cars are not selling all that well. It's middle America, normal America, buying cars that they want.
Now we've got gasoline prices creeping back up again, and I know that this is maybe, potentially due to Hurricane Isaac, might only be temporary, but nonetheless, as gasoline prices do creep up, would you expect that the smaller car segment, or perhaps the more environmentally friendly segment like the Prius, will start selling more?
The Prius has been selling pretty well, but it's the small cars. I don't think America really is ready quite yet for the really, really small cars. Those aren't selling all that well, except in the cities. When you get out into some of the smaller towns in the country, the little cars don't sell all that well. So there is a big market for hybrids, but not
Scott,
for the real small stuff.
Scott, that's always been the case. Middle America is not the place where you're going to find a whole lot of Mini Coopers. You got to go to the smile of America, the coast and to the south, and really the big cities. That's where you see those microcars, those subcompacts.
Absolutely. There's lots of them lining my New York streets. Scott, Phil, we've got to leave it there. Thank you very much.